Most business owners check their income statement every month and they think they know how their business is doing. The secret is they don't. There's one financial report sitting inside your QuickBooks right now that will tell you whether you are actually building wealth or just staying busy. And I can almost guarantee you've been ignoring it. It's your balance sheet. And today we're going to change that. Welcome back to CEO Numbers Network. I'm Danielle Hayden, CEO and founder of Kickstart Accounting Group, where we help business entrepreneurs like you understand your numbers so you can make real CEO level decisions with them. We talked about what it means to build a valuable business, not just a business that pays your bills, but one that creates real options for your future. Options to step away, options to sell, options to create personal wealth. And I left you with one question in that episode. How do you actually measure whether you're building real value? Today, I'm giving you the answer, and it lives in the one report most business owners open once a year, hand to their accountant, and never look at it again. It's your balance sheet. Let's make this simple, practical, so that at the end of this episode, you're going to know exactly what to look for every single month so you can actually use this thing as a CEO tool it was designed to be. Now, I want to simplify this for you because I think the accounting jargon is what gets in the way of the balance sheet. Your balance sheet is a snapshot in time. It's not like your income statement, which covers a period, a month, a quarter, a year. Your balance sheet is right now. It says at this exact moment, here's the full financial picture of your business. And it shows three specific things: what your business owns, like what you own, what your business owes to other people, and what is left for you. In accounting language, that's assets, what your business owns, liabilities, what your business owes, and equity, what is left for you. But I want you to stop thinking of it as an accounting report, and I want you to start thinking of it as your wealth report. Here's what each section actually means when you think of it as your wealth report. Assets are what your business owns. Cash, accounts receivable. Money clients owe you. Equipment, property, inventory. These are the things that create value inside your business. If you were to go and sell them, you would be able to liquidate them for cash. Liabilities are what your business owes to other people. Credit cards, loans, line of credit, that money you borrowed to get you through a tough quarter, to get started, that growth season. Every obligation you are required to pay. That's what lives in your liability section. Now, equity, this is what's left, assets minus liability. This is your ownership stake in the business. And for most small business owners, this is where things get really messy because this is where all of your owner's draws lie. The personal expenses you run through your business, the retained earnings, it all lands inside of equity. And this is the section that tells the world whether you're building a valuable business or you're just quietly draining it with all of your owner's consumption. The biggest mistake business owners make, and I want to be very direct and clear with you, business owners are laser focused on one thing: minimizing their taxes, reducing what we owe Uncle Sam. So they minimize their profit on paper, run personal expenses through the business, and then take out as much cash as possible. And I understand the thinking. I do, in logic. Here's the problem. When you do that, you are reducing the value of your business from the outside looking in. When there is no profit showing on your financials, there's no stability. There is no strength. There's nothing for a buyer, a banker, or an investor to look and say, wow, this business is worth something. You cannot build a valuable business and simultaneously drain every dollar of cash from it. Those two things are in direct conflict. And if you want to eventually have options, like real options, you need to make a choice about which path you're on. So what does a healthy balance sheet look like? There is no perfect formula here. This is not like your income statement where I can say you want to be at 15% net income. So there's no specific targets, but I'm going to give you 4 principles I want you to carry into every single monthly review with you. Principle 1, your assets should be greater than your liabilities. You should own more than you owe. More cash, more receivables, more equipment, more of what the company has built than you have in debt. That imbalance is what creates real stability and value in your business. Principle number 2, you need a cash surplus. Cash is not sitting there doing nothing. Cash creates flexibility, Cash creates security. Cash is the thing that lets you pay your team, invest in opportunities, and weather the unexpected. And I want you to trust me as a business owner. The unexpected always comes. Our standard guidance for clients is to have 1 to 3 months of operating expenses held in cash at all times. This is your cushion. All right, principle number 3, your debt must be intentional. I will say something here that might surprise you a little bit. I actually love debt. I do. I love debt as a growth facility, but I love debt when it's used strategically. Debt can fuel growth. It can create opportunity. It can allow us to see the future. The problem is when business owners take on debt, but the revenue and profit never grow alongside it. Now you don't have enough cash to service the debt, and now the debt is working against you instead of for you. Only take on as much debt as your business can actually pay down over time. That's the line here. If your debt is covering the operating expenses of the business, we need to fix the business's problem before taking on more debt. The debt cannot fund normal business operations. All right, our 4th principle is to protect your equity. This one's critical, and I see so many business owners getting this wrong. You cannot take out more cash in draws than what the business is producing. Full stop. When you pull cash out through draws beyond what the profit supports, you are not rewarding yourself. This is not a good thing. You are pulling value out of the business. You are weakening your own business. And over time, that catches up with you. Not just with the IRS, that's secondary. Your equity section is your value scorecard. Anyone who ever looks at buying, partnering with you, lending to you, they will look at your balance sheet, including your equity. Protect it. Stop taking out cash in draws, personal expenses, and tax payments that exceed your profit. It's hurting your cash and it's hurting your value. All right, so how do you actually use all this information as a CEO? Step 1, you're gonna look for the trends. You cannot just look at 1 month in isolation. Look at them over time. Is your cash going up or down over time? Not just month to month, right? We can be on this roller coaster as a business owner. I want you to step off the roller coaster. Look at the trend. Cash going in the right direction. Is debt increasing? Are you building assets? The trends are the story. And your balance sheet tells you what's happening inside your business, not what you want to believe is happening in your business as a visionary. Now, as you look for these trends, I want you to step into your seat as CEO and actually journal out what's happening, why it's happening, and what you're going to do about it. Because just like as a CFO, I used to report to my board of directors. I couldn't just come into a board meeting and say, yeah, well, our debt's moving in the wrong direction. Better luck next month. I had to say, here's what happened, here's why it happened, and here's what I'm doing about it. I want you to take the same responsibility. Step 2, we're gonna catch the problems early. If your cash is going down and your debt is going up at the same time, it's a red flag. This is your CEO moment to act on. You cannot wait until it becomes a crisis. The business owners who use their balance sheet every month are the ones who see the problems when it's still manageable, when there's still time to take action. Step 3 is to use it to evaluate your decisions. Every time you're thinking about a new hire, a new training program, a new investment, piece of equipment, I want you to ask yourself, what does this do to my balance sheet? How does this impact my cash? What does it do to my debt? And most importantly, how does it impact the long-term value of the business I'm trying to build? This is CEO level thinking, and it is available to you every single month if you are actually reading this report. This is not some abstract strategy. I see this play out with real business owners every single day. When a client comes to us and their balance sheet is a disaster, negative equity, debt that doesn't match, personal expenses buried everywhere, they often have no idea because their income statement maybe air quote looked fine. Balance sheet, that's where a lot of the bookkeeping issues happen. So they're profitable on paper, but underneath the business was dismantled. Bad decisions accumulate on your balance sheet, and we cannot build a valuable business on bad data. Clean books are not optional. They are the foundation of every good decision you will ever make. And here's what I want you to walk away with today. Your balance sheet is not a tax document. It is not something you look at once a year and hand to your accountant. This is your wealth report. It tells you month by month whether you are actually building something or running hard and staying in place. Look at your cash trends, your debt, your equity, and ask if this is moving you in the right direction. Is what I'm building actually building? If you're sitting here thinking, I don't know if my balance sheet's accurate, I don't know what mine says, and I'm not sure I can trust these numbers, that is where we start. This is the work we do every single day inside Kickstart Accounting. We clean up the books, we build the reports, and then we walk through your numbers every month so you can actually understand what they mean, so you can finally make CEO decisions, so you can build something real. Head to kickstartaccountinginc.com and book a discovery call. We will look at your balance sheet together. We will tell you what is healthy, what needs your attention, and what the numbers are actually telling you about the business you're building.